Trading should be fun and very simplified. So in this video, I'm going to show you guys how to confirm your trades properly. This is not going to be a full trading strategy, but this is a part 1 of this video so that you can understand how to make your entries. So this video is going to be very simple and it's going to be very short. So please stay tuned with me, because in this video, we are going to cover liquidity taken, shift of market structure, fair value gaps, supply and demand zones, and even a confirmation candle. So you will understand from the structure to the liquidity, fair value gaps, and even know how to make your entries, including the stop loss and the take profit. So without wasting any of your time, so let's begin with the video. The first thing that we are going to cover in this video is shift in market structure, guys. Most of the time you see that the market is moving to the upside, making higher highs, higher highs, higher highs. But suddenly we have a sharp move to the downside, breaking the previous lower high like this one here. So from here, we understand that once the market is moving like this, if the market doesn't break to the downside, if it doesn't break the last higher low, the market will keep moving to the upside. So that means we'll have a new higher low here, and then we have a new higher low here while the market is moving to the upside. But once we see that the market has broken this low here, the previous higher low, we will predict that the market will eventually move to the downside. But that's not always the case, because the market will always make some funny moves in reality, because this is just a basic structure that will never happen in the market most of the time. Trust me. So from here, let's say we are moving to the upside like this. Here, this one will be your impulses. This will be your corrections. So from here, you have to understand that the impulses will set the direction of the trend, and the correction will move opposite. So what I mean is that if the market is bullish, the correction will be bearish. Something like this. We move aggressively to the upside, and then we consolidate like this, and then we move again to the upside. But here we have a lot of things that we have to consider, because the market will never move with a sharp move like this. This will never happen, guys. This will never happen. So the market will eventually do something like this. It will move like this, like this. Let me just do the correction with blue. It will move like this, make a new high like this, break to the downside, make another move like this, and then shoot to the downside again. That's how this correction will build up. And most of the time, this impulse here is fast, and then the correction here is very slow. So what I mean is that this move here can take up to at least, let's say, maybe a day for demonstration purposes. And then here on the correction, it can take up to maybe 5 days before we can see another move to the upside. That's how you should understand it. But for the shift in market structure, guys, we have to understand that we are focusing on the last higher low, even if price is doing something like this. So guys, from here, we need to focus on something that is very basic. Let me demonstrate it to you. To find this low here, we will use candlestick patterns here. Let's say for now, for an example, we have this move here like this, and then we have this move here like this. And then suddenly we see that we have this bearish candlestick like this, like this. So from here, we can see that this move here, the bearish move, is overpowering the bullish trend. So the market will look something like this. It will be bullish, and then the market shoot to the downside. So this is your shift in market structure. Okay, I hope you understand very clearly. If you use candlestick properly, you will understand this concept very simple. It will be much easier. And then in the lower time frame, that means you'll be looking for the market to do something like this before we can see another move to the downside. Okay, I hope everything is. So from here, this one here, we have the first shift in market structure here, but we can still have an internal shift in market structure. So that means right here, you'll be looking to go long here. The same applies on the bearish side of the market. The market might do something like this. It will shift, break this last higher low, and then manipulate the high here, and then make another shift in market structure, break another higher low here, and then we will predict that the market will shoot to the downside. I hope this example was very helpful, but if you don't understand, please comment below. I'll make another video which is going to be a long one. So from here, you can see that we have a liquidity taken. Here, guys, this is where the shift in market structure will happen. even in here, we have a liquidity taken, meaning price was doing something like this, and then suddenly we have a sharp move to the upside, and then we break the structure. You can see here, we break the structure. Then that means anything that comes will be looking to go short. Even in here, we'll be looking to go short because we have tapped the high and then broke lower. What I mean is that we have to see if price was going to move to the upside, this low should be holding like this. This is the basic structure. Once price breaks this, that means we might see a reversal to the downside. I hope you understand. This is just a liquidity take. Can you just find something like manipulation? It's just a manipulation. For an example, we have this low here, and then price broke this low, but price did not break this low again. It shoot to the upside. While we were waiting for this move to the upside, the market shoot to the downside eventually. I hope you understand it. It's just very clear concept. But then let's move on to a more practical example. We have fair value gaps. We have fair value gaps right now. We have unbalanced and balanced fair value gaps. In fair value gaps, we have to see a week. You see this week here, and this week here, and this week here. We have 1, 2, 3 candlestick. If the wicks of this doesn't touch here like this, that means this is an unbalanced fair value gaps. Like this, we have this and this, the first and the third candlestick. We have a space in here. So meaning we will be predicting that the market might balance this price section before it can shoot to the upside. Even it applies in the same way like this, the market might do something like this. But if you see something like this, that means this one is balanced. We can see that the wicks are just everywhere. But if we look closely, guys, on this example, we can see that we have this fair value gap here. From this area here, price was not balancing. Price was not balanced, if I may say. So that means we will be having an FVG here. That is why you see this candlestick closing this gap here, trading here, and then move to the upside. This space here in between. I hope this is very simple, but to understand fair value gaps, guys, is very simple. You can just learn it in a day. You'll find a lot of videos online, and I've been covering this a lot. So we just have to skip this one. If you want to know more about fair value gaps, there's a link in the description below. I'll put it there. And also don't forget to subscribe to the channel and leave a like. Now let's go to the fun stuff here. We have supply and demand zones, but we will start on the demand zone because this is where we'll be looking for bearish trades and long positions. Always make sure that you draw your demand zone from the last bearish candlestick. Let me say you draw there. If you see this move here, you have to wait for this candlestick and then wait for a huge move that is trading above it to be a valid demand zone. Let me find a better way to explain it, guys. You can see we have a blue candlestick and then a red candlestick here. This one is a bearish candlestick. And if you look closely, this candlestick here is bigger than this one here. So that means this will create a demand zone. And always make sure that this candlestick close above this bearish candlestick. For sometimes you can have like multiple candlestick like this one here. You can clearly see that we have the first candlestick here, and then we have the second and the third. But here we have 2 red candlesticks. So that means for now here, your zone start here to here, but you can still use the last candlestick. But remember, the zone start here and it ends here. This is your whole demand zone, something like this. This is the true demand zone. This one here, we're just doing it just to minimize the risk. I hope you understand, guys. This is I know sometimes it can be a little bit complicated at first, but it's very simple to understand. So meanwhile, if we have a single candlestick, that means we'll be looking for a price to come here and move to the upside. Same applies here, move to the upside. Same applies here, move to the upside. But sometimes price can even come to these areas, but I'll show you one example. On supply zone, we will be looking for a bearish trade. This is where we'll be looking for the market to move to the downside only. Here we have a single candlestick. This is just vice versa, because here you'll be looking for this bearish candlestick, bullish candlestick, and then this move here. And guys, if you look closely at this two here, look closely guys, I want to show you something. Let me just put a line here like this, and then we have a line here. Look at this bearish candlestick here. This one was liquidated, if I may say, or maybe manipulated. So that means the zone will start from here to the higher high of this candlestick. But because here, the zone will start here. Let's say we put the zone from here, but right now we take the one with a higher high. This is your invalidation level. So that means right now you'll be waiting for the market to come here and then shoot low. Same applies here and then trade low. It goes like this to trade low. That's how you should understand this. Very simple. It's not going to be difficult to understand it, but for now I would say this is pretty much simple to understand if you understand this concept clearly. But let's move on to a more practical, let's do examples. This is your confirmation. Because right now, you know, a shift in market structure, fair value gap, supply and demand zones, liquidity. That's all you need to build a trading strategy. But right now, we have to make a confirmation strategy. Have to make a confirmation strategy. So what I mean is that we can see we have a demand zone. We can clearly see that we have a small fair value gap. Let me say FVG. From here, you will wait for, this is your demand zone. You'll wait for the market to come to the zone and then close bullish. That means right now, this is your confirmation candlestick. You will enter the market when price closes with this candlestick, and then your stop loss will be here with added spread size. The same applies in this area. We have a shift in market structure. We have a manipulation. We have a fair value gap here. We can see price came and closed it. But then you will wait for the market to give you this bullish candlestick. This will be your confirmation candlestick. This is your confirmation. Okay, and then you wait for the market to move to the upside. And also, as you already know, we have covered this candlestick pattern here. I'm not going to touch on that today. Even here, we have touched the rejection candlestick plus the retracement. We have already done that. So let's move on to this one here. Even here, we can see that we have a huge fair value gap here. So that means the market will shoot to the downside, come to the supply zone. You wait, and then for this candlestick to close, and then you sell. That's how you should understand this very clearly. And also, you can clearly see that the same example here is the one here. So that means you catch this trade and then you catch another one here. Only if you know how to read the market in the same time frame. Because I see a lot of people like to move from time frame to time frame just because they want to reduce their risk. But sometimes it doesn't work like that. You just have to stay on the time frame and focus on it, because that's the only thing that will work out. If you move on to a lower time frame, you'll put a lot of stop losses everywhere. The market will chow your account and then you blow it. And then the market will just move. Let's say for now, you have entered this one here. Let me just explain it here. You have entered the market here. And then you put your stop loss here. I know some people will do it. But if you put your stop loss here, you will be safe. But in the lower time frame, you will enter and then the market will just stop you out because your stop loss is right here. Then the market will just move. So you just have to do something about your trading skill right there. And some of the things is that, let's say you enter right here. When the market moves a few pips, some people will just take their stop losses and move them to break even immediately. So then the next candle will just chow them and then move to the upside. And then you'll start to question your trading strategy. That's how the market behaves. You just have to be patient. So I guess I'm done explaining this one here. So let me touch on this complex one here. It's not very complex. Let's just say we have a manipulation to the upside because the bullish candle manipulated this bearish candle here. And then we can see a series of bearish candlesticks. Then we have a supply zone. And then we wait here. This is a rejection candle. And then you wait for the market to go to the downside. But then what if you have missed this one here? Let's say you have missed this one. The market is right here. You just have to think of price action in a different way. You already know that the market already confirmed here. Let me just draw a zone here and see if I can be able to enter the market here. Let's draw the zone. We have a zone right now, and the market has already touched here with this candlestick, and then we wait for the market to give us a bearish candlestick to confirm the trade, and then we enter, put a stop loss here, and then we wait for the market to move to the downside. That's how simple it is to understand this. I might say this is a full trading strategy, but it is not. This is just some basic things, because if I go deep, it will take me like 4 hours to record this whole video. But I guess in the near future, I'll just make a huge video on this topic, because there's a lot of things that need to be covered, because there's a lot of different types of confirmation candlestick here. This confirmation here is not the same as this one here. They are not the same. And we have a different entry strategy to make a sniper entry just using those confirmation candlestick. So right now, let me show you what you should never do in the market. This is what you should never do. We can see that we have a zone here, but there is no bullish candle here that traded above this last bearish candlestick here. It ended up here. So even if you try to enter it, let's say you say this is your demand zone, but once price tap the zone and then trade below it like this will invalidate the whole pattern, because price traded below the demand zone where we should be putting our stop loss. Even though price has moved to the upside, we just have to forget about it. Okay, the same thing applies on this side. We have a supply zone here. Price moved to the downside, come, and then before we can get a bearish candlestick close, price suddenly trade above it and then close bearish. But this should not worry you for now, because we will be covering it on how to make an entry like that. But I have covered it in some videos, but you just have to go through them. You'll find it there. And also, guys, don't forget to subscribe. You're on the road to 100,000 maybe. Let's look at this example. Okay, I made a mistake here. This is what most of the things will happen. Most of the price action will happen in this area. Like if we make it this, let's make this a complex setup. We have liquidity taken, we have a break of structure with a market shift. Okay, then we have a confirmation, we have a demand zone. So that means I can enter this trade and then put my stop loss here. Is it risky or not? Let's find out. Let's see right now we have entered our trade here. Okay, right now that means we are still in a loss from here. This will be our loss and is very close to our stop loss. But because we don't see price action the same way, some people will see a zone here, but this one did not confirm because it traded above the supply zone, and then we have another one here for sell, and then the market moved to the downside. But this doesn't mean this person is wrong. No, it's because he entered the market way too early. So that is why you see prices moving to the downside before it can move to the upside. So for now, let's see, we have the zones, but this one has been invalidated. This one is right, and plus we also have a rejection candlestick. But you are still in a loss, and someone profited from your loss here. So because price is close to your stop loss, I know some people will just close the trade, and then they will forget that the market will eventually move to the upside from here, and then they will catch even the bigger one here. This one will catch a small one while you catch the big ones here. And also, while the move is moving to the upside, you can see another one here with multiple candlesticks, but there's no confirmation because there's no price that touched the zone. And then we have this one here, and then it confirmed with a bullish engulfing candlestick. Or also you can say it confirmed here, a stop loss here, then move to the upside. That's how you should understand it, guys. I hope this video was very simple, but in my brain I think like it's very difficult. But if you rewatch this video again and again, you will understand very clearly on how this thing works, especially the confirmation candlestick, guys. That one is very important. Even if we talk about this area alone, we have a confirmation to the downside. Here we have this move here. This is your supply zone, and then we have this candlestick. It retested this, but then we'd be waiting for the market to close bearish. That is why you see this move happening to the downside. I hope you understand a little bit of that. Even if you have tried to enter the market here, there is no confirmation to the upside. There is no bullish candle close, so that means you will avoid it. Even here, if you try to sell like this one traded above, this one you could have caught it with this move, maybe TP here or maybe here, before this move was going to happen. But you just have to understand a little bit clear. But if you have any question, guys, please come to Telegram and then ask me a question about this. I'll respond to you. Don't worry. I guess I'll see you on the next one. Don't forget to subscribe to the channel.